Hi, my name is Griffin Bridgers. This is part one of a series on the basics of generation skipping transfer tax. And today we're really going to dive into basic principles and definitions that drive the generation skipping transfer tax, which I'm going to refer to as the GST tax throughout this series. As always, before we get started, I want to remind you that this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So, what is the purpose of this series? Well, it's designed to teach the basics of generation skipping transfer tax, or GST tax, to attorneys, wealth advisors, CPAs, and other aligned professionals who deal with intergenerational transfers of wealth. So, to get the most value out of this series, I suggest that you first know, or at least have some knowledge of one, the calculation of estate tax and its associated deductions and credits, and also the calculation of gift tax and its associated exclusions, deductions, and credits. If you're not aware of those or you don't know some of those basic things, the principles are going to be wrapped into this series, so if you don't quite understand those, you may get lost at some points. So that's my caveat and warning before you dive in. So, what is the generation skipping transfer tax? Well, the GST tax is an additional layer of estate tax or gift tax that applies to a transfer that intentionally skips recipients in the next youngest generation in favor of recipients in an even younger generation. So we'll show an illustration in a second. But, in other words, a better way to state this is that if you make a gift to a living or future grandchild instead of a living child, this is the type of transfer we're dealing with. So, there's a couple points here. I'm looking at an intentional skipping of a generation, and I'm emphasized living or future grandchild because, as we're going to see later, you could potentially have some GST tax exemption that applies in that type of situation because down the road, for example, if you put property into trust and there's no grandchildren living at the time, but later grandchildren are born who are beneficiaries of that trust, there could potentially be a GST tax event that occurs when a distribution is made from that trust to a grandchild. Now, why is there this additional layer of tax? Well, it's because it's assumed that the estate or the gift tax will apply once per generation. So, if you intentionally skip a generation, the IRS misses out on a layer of estate or gift tax revenue that they would have otherwise received. So to illustrate this, we have a simple diagram here where we have generation 1, the parents who, lucky they have $1 million or $100 million. We're going to assume they die and leave that $100 million to the next generation, their kids. Now, there's an estate tax on that $100 million under current laws and exclusions right now of $35,176,000. That leaves a net going to the kids after estate tax of $64,824,000. Now, the kids then die and leave that same amount to their kids, Generation 3, who are the grandkids of the original parents who kicked this off. Now, when the kids die, there is an estate tax of $21,105,600 on the amount they had, assuming we're using the same exclusions, credits, rates that we have in effect today. And that leaves a net amount ultimately going to the grandkids of $43,714,800. So as you can see, that $100 million has shrunk rapidly by the time it reaches Generation 3 after starting at Generation 1. So that begs the question, could we skip Generation 2? Could we just leave the whole $100 million to the grandkids? And if you do that, guess what? You save estate tax of $21,105,600. Because you don't have to wait until the death of Generation 2. Instead, you're just skipping Generation 2 to leave all that wealth to your grandkids. So this is the problem that the GST tax is designed to solve. Now, it's not a perfect solution because what I didn't illustrate is there could be generation 4, great-grandchildren. And if the parents leave property to the great-grandchildren, they could skip 2 generations, but there wouldn't be 2 layers of estate or GST tax then. Instead, there's only 1 layer. So the GST tax only applies once, even if you skip multiple generations in one transfer. So how does the GST tax work? Now, this is a wordy slide, but I promise you I'll give you more color to this in another illustration after this slide. So, you don't need to master this now. This series is going to dive into the mechanics of the GST tax in much greater detail, but I want to emphasize that it works differently than the estate and gift taxes. This is where it's important to know how estate and gift taxes are calculated, but just to give you some basic principles, because these are going to be completely different, we have estate and gift tax rates that are graduated from 18% up to 40%. Most of the time, because of a generous exclusion, we're operating in that 40% realm before we're ever actually calculating any estate or gift tax. But as you know, estate and gift tax liability is really based on the amount of a transfer based on its fair market value at the time of the transfer, but offset by an applicable credit, which is represented by the amount of estate and gift tax which would be owed on an exclusion amount that is given to every individual taxpayer. That exclusion is made up of a basic exclusion amount of $12,060,000 that everybody gets and that currently is adjusted for inflation every year. And you could potentially also have counted in your applicable credit a deceased spouse's unused exclusion that might have been preserved through a portability election made by the deceased spouse's estate. Now we're going to contrast this with the GST tax, which instead is driven by an applicable rate. There's no credit or anything here. We have an applicable rate that is fluid, and that fluidity is based on taking the maximum federal estate tax rate, which is currently 40%, but is incorporated by reference into the GST tax rules, and multiplying it times an inclusion ratio. And that applicable rate gets locked in, especially if there's a transfer to a trust, where no matter what the trust grows to, any distributions to certain skip persons, as we're going to learn about, maybe grandkids, great-grandkids, or even a termination of the trust where it goes to kids or to grandkids or great-grandkids, will be multiplied times that applicable rate. So to get that applicable rate and that inclusion ratio, we start with the fact that everyone has an additional GST exemption, which is equal to the basic exclusion amount of $12,060,000. However, I want to emphasize that this is a separate and independent exemption, so the use of basic exclusion as an applicable credit against gift or estate tax liability will not reduce the GST exemption and vice versa. But note that I said basic exclusion. This is where knowledge of the estate tax and its definitions comes into play, because if you have a deceased spouse's unused exclusion preserved through a portability election, that only applies to the gift or estate tax. You cannot preserve a deceased spouse's unused GST exemption. But that being said, the inclusion ratio is determined by comparing the GST exemption applied to the dollar value of a transfer. So you have a fraction, the numerator of which is the GST exemption you apply to a transfer, and the denominator of which is the net dollar amount of that transfer after reduction for any estate tax that was paid and after reduction for any charitable gift or estate tax deductions. And you figure out that fraction, subtract it from 1, and multiply it times the maximum federal estate tax rate, and that will give you your applicable rate for GST tax purposes. So that's a mouthful, I know, but I promise you we're going to break these steps down as we go through this series. So here we have a quick illustration incorporating some of the facts we looked at earlier. So at the top, you'll see the estate tax consequences, and at the bottom, you'll see the GST tax consequences. So as we saw before, we had an estate tax on a transfer from generation 1 to either generation 2 or 3, depending, of 35,176,000. And that tax is really a tax of 39,945,800 on the 100 million transfer minus an applicable credit of 4,769,800. That's how you calculate the estate tax. It's the tax on the entire transfer minus the applicable credit. I want to emphasize again, this ignores the existence of any deductions or credits or anything else that Generation 1 might be entitled to receive. But long story short, we end up with a net amount after estate tax of $64,824,000. We're going to assume here that that's passing to Generation 3, the grandkids. And we're going to then, after that estate tax is netted out, look at the GST tax on that amount. So to start with, we really need an inclusion ratio to determine our applicable rate, which we're going to multiply times the highest GST, the highest estate and gift tax rate of 40%. So, as you can see in the calculations down in the bottom right-hand corner, we have our GST exemption, assuming we assign that a whole exemption to the transfer. So that's in a fraction, the numerator of which is that GST exemption, the denominator of which is the net amount after estate tax that's being transferred to Generation 3 by Generation 1. So we take a fraction, which is 1 minus that fractional amount, and we multiply it times the highest gift or estate tax rate, which is 40%, and that gives us our applicable rate that's going to forever apply to generation skipping transfers here if this is a transfer directly or in trust. And that amount is rounded to 32.5583%. And if we take that percent applicable rate and multiply it times our transfer, the net transfer after estate tax of $64,824,000, that gives us a GST tax of $21,105,600, leaving the grandkids with a net of $43,718,400. But wait, you say, these figures look familiar. We saw them back here on this illustration, and the answer is yes. The amounts just happen to work out perfectly here, that they are the same in terms of the ultimate tax liability and the amount going to the grandkids. The only difference is if we replace the second red box with GST tax instead of estate tax, the amount ends up being the same. But nonetheless, the calculation is completely different. In this case, we have a GST tax instead of an estate tax of $21,105,600. So you can see how the GST tax works to create that extra layer of estate tax and duplicate it that would have been received had this been a perfectly implemented plan going from generation to generation without taking into account transfer tax consequences. So, like I said, all of this will be illustrated in greater detail as we go through this course, but for the time being, what I really want to introduce today are some of the definitions that come into play, because the GST tax is heavily driven by definitions, and knowing those definitions is going to be half the battle of being able to assess when the GST tax applies, to what types of transfers it applies, and really when it's invoked in terms of either the GST tax itself or, as we're going to find out later, the use of GST tax exemption, because GST tax exemption can be used before a GST tax might apply, for example, in a transfer to a trust, so that future distributions from that trust to maybe grandkids or great-grandkids won't be subject to the GST tax. So to start with, we go to Code Section 2601, which simply says that the GST tax is imposed on every generation skipping transfer. So we don't necessarily need to remember the specific definition of generation skipping transfer, because it's broken down into certain subcategories which are their own independent definitions in Code Section 2611. So in Code Section 2611, a generation skipping transfer is defined as being one of three events: a taxable termination, a taxable distribution, or a direct skip. each of those definitions is going to get its own separate video in this series. So if you don't remember that now and don't know these terms, don't worry. We're going to introduce each with its own dedicated video session coming up as I go through this series. Then finally, there are some other GST definitions which are going to come into play, which we'll cover in greater detail as we go along, because they can change a bit. But they're a little more simple, as we're going to see, at least in some cases. The biggest one we'll need to know is just simply the transferor, defined in Code Section 2652. We'll also need to know what a skip person is, defined in Code Section 2613, and also maybe what an indirect skip is for lifetime transfers to a trust, which is defined in Code Section 2631. Like I said, we'll cover each in turn. But here's a quick illustration of how two of these interact, because what you're really going to want to know are transferor and skip person, because when you have those two parties on different sides of a wealth transfer, that is when the GST tax will apply. So to illustrate here, using our previous facts, we have generation 1, the parents. Well, guess what? They'll be defined as the transferor or transferors here. And then we have the skip persons, who are the grandkids in generation 3. So anytime there's a direct or indirect transfer of wealth from the transferor to skip persons, that is where the GST tax can apply. But the technical way we look at this is anytime there's a situation where the transferor is subject to a gift or estate tax, or might use gift or estate tax applicable credit for amounts that might pass to or for the benefit of skip persons with respect to the transferor. Now that could include a direct transfer from the transferor to the skip persons, but as we'll see later on, it might also come into play in situations where maybe there's an already existing transfer that's gone to skip persons, but then the transferor becomes a new person, maybe generation 2, perhaps because generation 2 is given like a general power of appointment over a trust that is passing for the benefit of those skip persons. So really we're looking at the inclusion of an existing or new transfer in either the gross estate or in the taxable gifts of a transferor, long story short. So that'll tee up our next discussion, but for the time being, I hope this was a good intro to the GST tax for you. This is a series I'm excited about and excited to continue to develop, just because there's a lot of resources in this area for practitioners that are missing. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. But I thank you again for joining me for this part 1 of the series on GST tax basics, and I look forward to seeing you in the future parts of this series.